with another session in our Reimagined Resiliency series, proudly supported by Newmont Porcupine. Our session today, Laying the Foundation to Achieve Maximum Business Value, is proudly supported by the Business Enterprise Center and the Venture Center. And our members and small businesses that have joined us today via our 32 Northern Chambers of Commerce from all the way from Temiskaming Shores to Kenora, so welcome. And I'm going to pass the floor to Mike from the Business Enterprise Center, following with Roxanne from Venture Center, just to welcome everybody.
Thanks, Jasmine. So as Jasmine said, my name is Mike Scott. I'm the Business Development Consultant at the Business Enterprise Center. And we are your local small business enterprise center supporting the region from Timmins all the way to Hurston, Hornepayne in the west and up along the James Bay coast. So we work to help businesses launch, expand, and grow. And we're very proud to support this event and to bring such specialized expertise to our local business community. So thank you so much for having us.
And I'm Roxanne Daou. I'm the Executive Director of the Venture Center in Timmins. We're your local Community Futures Development Corporation. And our role is to support economic growth in rural communities by supporting businesses through all of the different stages, including the startup, maintenance, and expansion. And we provide funding as well as business consulting to help those businesses achieve their next goals.
Awesome. And I'd like to welcome Stephen, Jacob, Tyler, and Bob with us today. If you have any questions, anyone who's watching online, please just unmute to ask, and I'll pass it over to all of you.
Great. Thank you, everybody. Thank you for the wonderful welcome, and thank you for welcoming us to Timmins. I'm going to be looking two different ways here today, just so to make sure that I'm talking to everybody. Again, my name is Bob Carolli. I'm one of the partners in Rizolve Partners. We are an advisory group that help businesses build value. Typically, working with us, we can see an increase in value of 2 to 3 times. But today, we're here to talk about how you build value, and we're going to be talking about it with our partners from Sunbelt and from Kilgour, and I'll be introducing them a little later. But why are we here today? Why are we here today is a number of things. First of all, there's an age wave going through Canada. Nearly 2/3 of all private businesses are owned by baby boomers. And this means that there are about 1 million companies in Canada, small to medium-sized companies in Canada. And out of those, about 500,000 of them are expected to change hands by 2025. So a huge change on the Canadian business landscape. Interesting statistic, though, 58% of small business owners do not have a transition or a succession plan. So the idea is, yep, one day I want to transition, but I don't have a plan at this point. And statistics show that if you're not completely prepared for that transition, 70 to 80% of those transitions will fail or will fall to some default, which isn't ideal for the owner. And then, of course, we've got the 5 Ds. And don't ask me to go through all 5 Ds, but we're talking about death, divorce, and so on. The things that we don't count on that change the timing and change the situation completely. Next slide. So today our agenda is as follows. I'm going to go through a very brief case study because we like to refer to numbers as we go through our presentations. We're going to be talking about bridging the profit, quality, and wealth gaps. We're going to be talking about creating an intergenerational legacy, absolutely critical when you're looking at a transition plan. We're going to talk about the value gap support and liquidity options, and then converting your business value into maximum after-tax cash when you go through an exit. And then we'll leave time for questions and answers. And if the questions are complicated, why don't we keep them to the end? If it's a quick question or just a clarification, please, as Jasmine said, don't hesitate to unmute. So let's take a look at the case study very quickly. We're going to be talking about John and Mary Smith, the owner of ABC Company. Their ages are 59 years old. They've got 2 kids, adult kids, age 29 and 32, a couple of grandchildren, and like many of us, 4 aging parents. Their life goals are they're happy with their current house. They want to retire in 5 years. They like to golf. They like to travel. They like to spend time at their property in Florida. But they also want to look after long-serving employees. And that is what we very typically see that. For someone who's owned a company for a long time, they want to make sure that their long-serving employees are looked after. They'd like to live on $20,000 to $30,000 a month for the rest of their life. They'd like to leave $8 million to their kids and their grandkids. And they'd also like to give $4 million to charity as part of their legacy. Their investment objectives, they're liquid assets to be invested with moderate risk. They're not big risk takers, which is also very typical of somebody in their 50s and their 60s. And their personal wealth is about $1.5 million. And that includes a house, a Florida home, liquid assets, and they've got a mortgage against that of $300,000. And then finally, they've got a business, and the question is, what is the value of that business, their largest asset? They've got a great business that has EBITDA or cash flow of $2 million a year, and they've got about $300,000 of corporate investments. So we're going to be referring to this throughout the presentations, and you'll see why, because it's critical to be talking numbers as we go through this. So next slide, Steve. And I'm going to turn it over to Steve Cummings, the CEO and Managing General Partner of Rizolve.
Well, thanks, Bob. I am the managing partner of Rizolve Partners. We're a group of former senior executives with different disciplines within the firm: sales, finance, strategy, human resources, and data analysis. So if you have a business today that you want to grow in value by multiples, let's say 2 or 3 times, you're in a good place to hear how that might happen today. If you're a baby from the baby boomer generation, the average age 65 today, and you want to continue for 3 more years in your business, you're in a good place today as well. And then finally, if you've got no desire to retire from your business, but you would consider an offer if it came along, you're in a great position today as well. So bear with us. When I came to presentations like this as a global CFO, if I went away with 3 things on my scratch pad to take back to the office to really work on, I was really happy. I think you can get multiples of those today. So let's get into it. So Bob just touched on a case study, and you could see from the case study that the couple had a business that was producing $2 million of profit and EBITDA a year. And an average business of that size would command a multiple of earnings of, about 3. So we're gonna assume the value of that business for working purposes today is about $6 million, 3 times 2. 3 times earnings of 2 is 6. But in that case study, and this is an important point here because we've got a personal financial advisor around the table, and we want to introduce to you why having a relationship like that is really important. We need to know as business advisors, particularly in the sunset years of holding the shares in the business, we really need to know how much money you need after tax from retiring out of the business. In this case, they need about $12 million. If you're not familiar with the numbers in your own particular circumstances, just factor them down to your own situation and they'll still work. We had to pick a number, obviously. And then finally, the business owner wants $18 million out of his business. Why? Because a friend of his got $18 million for a comparable business, and he thinks that's a good number for him too. Why not? So remember those numbers, we'll come back to them. But immediately, what I'd put my finger on is, if he or she absolutely needs $12 million out of an exit, and they currently have a business value of 6, they have a wealth gap of $6 million, 12 minus 6. Current value versus the 12 that they want. So that's an important statistic, because as business advisors, we need to know what your target is so that we can figure out a plan to get there over a period of time. Okay? And then finally, The other gaps that we might point to here, which are important to know right off the bat, are what is your relative profitability in your business to a best-in-class business? In other words, where are you sub-optimizing? Because we can get benchmark statistics from the market like that, so we can figure out that gap. And then you can work on those things. And then finally, what is your current value of your business today? That's a tricky one, but we know it's 6 million because we've made that assumption. And where do we need the business value to be at the back end? Well, we just said we absolutely need a business value of $12 million. So that's what we're up against. Bob, move on. Yeah. Okay. So a couple of problems that we'd just like to highlight right out of the gate. There's some demographic and economic concerns around today. Bob mentioned the 5 Ds: death, disability, divorce, disagreement, and distress. Don't forget that those things creep up on the general population, and you can never quite predict how they're going to affect you personally. But the important thing that I want to make right out of the gate is an aligned advisor group, such as what we're going to present to you today, is really important to have around the table on your supporting you and making sure that you get across the finish line. Move on, Bob. Okay, so issue number one that we just want to highlight, the average business owner, and this is data from TD Securities, TD Wealth, in a big study, the average business owner has 85% of their wealth in their business. That's not a very diversified portfolio when you think about it. And that 85% is an illiquid asset until you move down the line. So that's a pretty shocking statistic. And as you move towards maybe thinking about retirement further down the line, you want to start reducing risk, putting in place wealth preservation strategies, thinking about pivoting to lower risk asset classes, and so on. So let's consider how we might do that. Before we do that, one further issue that I just want to put on the board here. Remember, we said that the value that the business owner here wants was $18 million. And why does he want it? Because his friend at the club got an $18 million price. Well, let's just take a look at that situation here. We got two companies. I'm going to go through this quickly, but you'll get the idea. We've got two companies, two comparable companies. They're both exactly the same. If you look at the track record, they've both got 25-year track records. You both look at the industry segment, it's the same. If you look at the size of the business, $30 million of revenue. And if you look at the profitability or cash flows, $3 million. Both the same. So when you say to yourself, well, how do you value company A and company B? Are there any differences? You would say no, based on the information you got. They're exactly the same. Whatever the value is, it applies to both. So let's just consider that when you've got more information. Let's look at company A. Well, company A's features is that its future prospects are poor. There's a lack of future visibility. A team to carry on any plan going forward is poor. The quality of the information to make decisions on are questionable. Risk is high of not living up to promises that they make, and the quality of the intangible assets therefore is low. Look at company B by contrast. Well, now company B, the future is bright. The quality of the information is high on which to base assessments and judgments. Visibility to the future is good. The industry leader, best in class. Quality of the assets is high, and therefore, what this serves to do is to showcase to you that the market will typically have a range of value for the same types of companies. One's at the bottom end of the range, maybe not saleable, maybe it is because on the basis of its size, and another one's top end of the range, best in class. Okay, so let's go on. Let's consider the what ifs that you might be thinking about. We've given you some data on common issues, and some of those issues highlight the why you should be thinking about these things today in the twilight of your career. So where do you start? What do I do? who do I go to for help and who can help and so on. So let's go on a journey to the possible, shall we? Move on, Bob. Let's start developing some answers with the aligned advisor team around the table today. Move on, Bob. So there's an Australian advisor that I've met, and he wrote a book called The Master Plan. So make a note of that. It's a good little book. It's only about 50 odd pages long, and it really hits the nail on the head. But in the master plan, he identified a successful exit strategy having three legs, and he characterized it as a three legs to a stool. And why did he use that pictorial? Well, we all know what happens when you take one of those legs away. It falls over. So in other words, what he was trying to say was each one of these things that need to be in your strategy. A successful strategy maximizes transferable business value for the end result to be a happy event for the business owner. Interestingly, he really puts emphasis on the owner being financially prepared, both in the business and personally. And then finally, he also interestingly says you need to have a plan for what's next, because people have a lot of remorse after they sell their business. So have a plan as to what's next. Move on. So let's first consider financially prepared. You know, all of your business life, you've focused on generating income. And what we're looking for here is for a pivot in your thinking, to more of a value focus. In other words, what is the capital enterprise value of your business? Why? Because it's that capital value at the end of your working life that is going to provide the income that you need to the end of your life. So let's refocus onto a value basis. And the reason we do this is we're looking to find a freedom point for you as advisors. So I'm going to go quickly through this, but this slide's important. You need to dwell on it afterwards. What we really need to understand when you start to think about, you know, retiring and moving on, or moving on to your next act, is what desired income level do you need in retirement? That's going to be married up with the level of wealth that you built, your investment portfolio, and so on. And then critically, the final piece to that formula is what's the value of your business. Okay? Once you put that together with the help of a personal financial provider, we will have a walk away number from your business that we need to drive to. We need to drive to in the sunset period of your ownership. So once we have your target number, there are all sorts of puppet strings that we can pull, like revenues, profit margin, multiple of cash flows that goes into the valuation formula, and the required growth rate that will help you get to that point. Another important point that we can't forget here is we need to understand what your time frame is. If it's only a year, you've got a limited number of things you can do. If it's 5 years, you can do an awful lot. And so we need to know what your time frame to retire is. Move on, Bob. So then, just to reiterate the three gaps that I referred to right out of the back, there's typically three gaps in your wealth that we can fill. We can fill with planning. First one is a profit gap. What do we mean by a profit gap? Is, well, you're underperforming. Typically, if you're not a best-in-class company, you're underperforming what a best-in-class company does. Well, what are they doing that you're not? Why are they making a better profit? We need to figure that out or help you do that. What is the value gap? We'll refer to value in a minute in detail. And then finally, what is the wealth gap that you're looking to fill so that you know you get across the line? Move on, Bob. Okay, so I want to give you a pictorial example of value. And we're going to start off with what we call, Bob and I call, a 2D valuation, a 2D, two-dimensional view of valuation that many business owners adopt. What do I mean by that? Well, they look to drive income to higher and higher levels. They look to increase sales, which increases profit level, but they don't look to the quality of their assets that drive those income levels. And so quality of assets remains constant, and hold that thought. So keep going, Bob. So typically most business owners will grow profits. In this example, we're moving from $2 to $2.5 million, keeping quality constant. And so valuation goes up to $7.5 million. Move on, Bob. And then finally, over time, profits go up to $3 million. And keeping quality constant, that drives a valuation of $9 million. But now what we want you to do, and here's the kicker, is we need to consider the quality of your assets. Because when the market looks at your business, they don't just look at the level of profitability. They ascribe a multiple of earnings to that level of profit. And the way they ascribe the multiple of earnings is on how they evaluate the quality of the assets that you built to generate that income and earnings. So let's move on, Bob. So pictorially, this is what happens. If you can convince a third-party investor that 4 times earnings versus 3 times earnings is an appropriate way to value your business, the size of the cube goes up. Move on, Bob. And typically, and the same thing goes if you can convince them that a multiple of earnings of 5 times earnings is appropriate because you have even higher quality of assets. Move on, Bob. But here's what happens. Here's what happens when you start to build quality in your business. It is almost, it's not a definite, but it's almost guaranteed that if you build quality, your profitability is going to go up. So we're reflecting that. So think about what that means for value. Value of the cube goes up 3-dimensionally. Move on, Bob. Now, if you keep building quality, the level of profitability is going to go up as well. So you'll get an exponential increase in value. Move on, Bob. So let me just frame that. Let me just frame that for you. This is a really important point to understand when you're thinking about increasing value in your business. Okay, so we started up with a business, $2 million of profit and a 3 times multiple, which gives a $6 million valuation. We then moved profitability up, or the business owner moved profitability up to $3 million, constant quality, meaning that they were able to drive value up with that strategy to $9 million. Nothing wrong with that. Nothing wrong with that whatsoever. However, let's look at what could be if you also built quality in your assets as well. So if you started off at $2 million of profit and you moved the multiple of earnings ascribed by the market to your business to 6, you've driven a $12 million valuation. Move on, Bob. If you also increase profitability as well at a multiple of 6, look how you get to $18 million. Interestingly, that's an exponential increase and it's driven by quality. So let's just focus very quickly, and this is important here. Well, how the heck does the market ascribe different multiples to the quality of your assets? Well, level one is kind of like the base case we're going to show you here. Level 1, we're going to characterize as what we're really looking for in order to have a saleable product is good, predictable profits and cash flows. Predictable profits and cash flows. And how does the market convince themselves that you've got predictability in profits and cash flows? Well, they're looking for a senior management team with diverse skills to implement plans like that. They're looking for a human resource function that can bring human resources to the table to execute your growth strategy. They're looking for recurring revenues, very important. They're looking for quality margins. And in particular, they're looking to whether those margins are higher or lower than the rest of the market. They're looking for the finance function to have financial operating reports that you can manage your growth around. They're looking for a sales plan and process. You won't believe how many clients we go to who do not have a documented sale plan and process, and it causes problems. Causes problems in the economic engine. Same thing with operations. You need operations in place to be able to fulfill the promises that sales have made. And if you're into a growth strategy, that can be counterproductive if operations can't dance to the sales department's tune. The next level of business that we would point to, the next level of quality that the market is looking for, is once you build your launch pad for growth, then you can put your foot on the gas through other types of quality. Firstly, they want to see a company strategy. They want to see a culture built around the employment that you have in the firm. They want you to understand your place in the market and what the size of the market is that you're addressing. They want to see recruitment and training policies for your HR so that they're fulfilling your growth needs as the company develops. They want to see product differentiation. They want to see a marketing plan and process. Once you've built a sales plan and process, then you can refine it with marketing plan. It's not normally the other way around. And then finally, think about finance and development of finance. Now we want finance to be reaching into the future in the way of a budget or forecasting. And you want an innovation plan. Move on, Bob. And then finally, as we start to approach best in class, predictable value is what we're looking for here. Well, what are the indicators that predictable value is more the norm than so on? You want to see a business profile. You want to see where the company sits in the range of value compared to its competition, and that's all documented. We want to see an audit of the financial statements, not just a presentation of the results by an accountant, which is typically the case. We want to see an audit. We want to see legal discipline, contracts and written sales ordering processes and so on. We want to see you addressing a growth market, not a declining market. We want to see barriers to entry, and we want to see a brand culture. So here we go finally, we're putting it all together here. We have a situation at the moment where we got a $6 million company. Rizolve would score that on this diagram at 50 points of value. What we're saying is that it is possible to double or triple the value of the company up to $18 million if you do certain things. So assessing quality of your assets and improving that is absolutely going to drive you into the orange. We want to see you adopting a plan and a strategy to move from 6 to 12 to $18 million. It is possible. It's very possible, but you need a plan. You need to know what your goals and targets are. And the final thing I would say is what we really want to see is when you've got a certain quality of discipline, we want to see that quality working in harmony, in balance. We don't want things to be lopsided. And so finally, I would say here are my scratch points for everybody around the table as a result of what I've just said. Firstly, remember that an exit strategy, there's 3 legs to a stool for that. You need to identify your freedom number. So you need a financial advisor. We want to see you with a financial advisor around the table as one of your key advisors. It is critical for signaling what value is that you want at the end of the piece in a transaction. It is critical for your negotiation posture. It is critical for your decision making. If you know what number you absolutely need, you can say yes to an offer. And that's really critical. Understand that for many business owners, your business is your biggest asset. So focus on its value in order to get to a place that you want to be. Finally, we would say Leverage is in the quality of your assets. In the way that I've just demonstrated, that's going to drive a higher and higher multiple, the better that you've got. You need a road plan. You need a road plan to get from A to B. And then finally, you need the right advisor team around the table. Thank you very much.
Okay. So next part of the presentation, as we segue into the financial advisor role. So my name is Jacob Johnston. I'm a consultant with the Kilgour Group at IG Private Wealth Management. Our group provides comprehensive financial planning services for our clients. So as you can see on the slide, that includes investment management, which is really at the core of what we do, insurance, so critical illness, disability, life insurance to protect your assets, tax and estate planning, charitable giving strategies, retirement planning, we do group benefits and pensions for businesses. And then we're also certified exit planning advisors, and we provide private company advisory, which is relevant to our discussion today. So what we do is we take all of these components of your financial plan and we consolidate and synchronize them into a simplified financial plan that's easy to understand. And then we create clear strategies and recommendations to help you achieve your goals, whatever those are. Right? So today, through the use of a case study, we're going to demonstrate how we add real tangible value for our clients using real numbers, real examples, and also, as Steve has alluded to many times, the importance of collaboration with a team of advisors around the room. And that's going to help you make fully informed financial decisions throughout every step of the way throughout the life of your business. So we look at John and Mary Smith. We went through the case study briefly. There's three primary goals that I'm going to talk about today. The retirement goal, which is $25,000 per month that they need to spend in retirement to live their desired lifestyle, and they want to retire in 5 years. So we have the timeline. The next is leaving a legacy behind. So they have what they think is more than enough money to live. Let's create a tax efficient estate goal. They want to give $8 million to their kids and their grandchildren. And they also want to leave a $4 million donation to some charities that they're passionate about. So as we assess the viability of these goals, as we look at whether they're in the realm of possibility or attainable, there's one major question that we have to answer. This is going to help with the collaboration with Rizolve and Sunbelt is what is their magic number? That is, what in 5 years do they have to sell their business for to ultimately make these goals a reality, to produce that asset base to make these goals a reality. So the first one, retirement planning, we'll talk about a bit of our process for this goal. Next slide, please. So the first part of our retirement planning process is discovery, and we've already shared the outcome of what that would be. So we'd have multiple meetings with our clients, really just trying to understand them, getting to know them, they get to know us. It's a very personal process. So really understanding their goals, their challenges, concerns, everything about their situations so that we can, ultimately identify their cash flow needs. But more importantly, something that's very difficult to do on your own is quantify those goals. So we can have a conversation with our clients and really understand how they want to live their life. They want to travel, they want to do all these things, they want to leave a legacy behind, but really quantifying and translating that to real numbers, requires careful financial modeling, and we can help provide that information. So next part of the process, once we've identified those goals and quantified them, is an investment strategy. So that's really, again, at the core of what we do. We're going to manage the money. It's very crucial to retirement or any goal, really, is growth of your assets to retirement and then ultimately growth of those assets as you draw from them in retirement. I can talk about this all day long, so for the sake of this presentation, we're just going to assume a reasonable rate of return, well-diversified portfolio, and that's a big part of that process. So we manage that for them. Next would be the income strategy. Again, this is once they retire, so in 5 years when they're looking to retire, sell the business, so the liquidation of the business to a liquid asset basis, how do we invest that money, and then how do we produce income from that asset base? And as a business owner, that can get complex. There's going to be multiple sources of potential income. You have your private corporations, so dividends from the corporation, investment income, whether it's your non-registered personal accounts, your corporate accounts, your registered assets, so if you contributed to RSPs throughout your life, CPP, OAS, annuity payments, maybe work on the side, have some earned income. There's going to be tons of components here. And ultimately what we're going to do is we're going to take all of these sources of potential income and give you the optimal combination on a monthly basis to produce that $25,000 per month in the most tax efficient way possible to meet your goals. Okay? And then once we put that together, we're going to determine a success rate. So this is just an example here, but ultimately it's a cash flow based model. So it's going to determine, can you produce $25,000 per month to life expectancy with a number of different variables at play? And what's the success rate on that? If it's 100%, then you made it. If it's 120%, you can ultimately cash flow a bit more than that. But that's what we're looking for, because we will be stress testing the plan, because there's so many variables, obviously over 20, 30, 40 years, that we need to stress test that plan and plan for potential things to go wrong, right? What if inflation is high, which is happening in the environment today? Market returns are less than we expect. There are a number of different things that could go wrong. We're going to plan for that. So when you're sitting on the beach in retirement, you're at your cottage and markets are down, and you have peace of mind that we've already accounted for some down years, a few recessions, whatever the case may be, it's in the plan. And then, of course, it's a dynamic, ongoing relationship with our clients. We adapt and monitor the plan as things change, as they always do, and we'll come up with strategies to make sure you're on track. So before we can determine the success rate of the retirement plan, obviously these are all integrated, right? The more you spend in retirement, the less you're going to have to move to the estate or charitable donation. So we're going to have to balance that out and integrate these all into the plan. So we're going to move to the estate planning. So we'll go next here. So the first thing that we're going to look at with the estate is what happens when you die. So what income tax might be due on my estate? So first is income to the date of death. So any income you produce to the point of death will obviously be taxable. We have a deemed disposition of capital assets that are in your name. So fair market value, and then 50% of that capital gain is included in your final tax return, and then tax-free marginal tax rate. Deregistration of registered assets. This is a big one we see a lot, is people stockpile money in their registered accounts, and it's a huge potential liability. If something were to happen and you don't have the rollover to a spouse possible, or something were to happen to both of you, 100% of the value of those registered assets are included in your tax return, and you're going to get a very heavy tax liability in that. So that's money that you've earned your whole life, you saved for, is going to be subject to tax at a very high rate at that point. So there could be strategies to deregister assets if it makes sense. And then, sale and liquidation of the business, again, capital gains, lifetime capital gains exemption could apply. But again, that's it's important to consider that well in advance to ensure that you're eligible for these types of exemptions and really plan ahead. So we can help with that. So next is some of the opportunities we have, some of the simple opportunities we have to defer or minimize that tax bill, prepare you for the stage. First is rollover assets. So like I mentioned, if you have registered assets, TFSA, RSPs, there's ways we can roll those over to your spouse to defer that tax until your partner ultimately dies. We have principal residence exemption, so play with that, and also estate planning. So this is where we get into a little bit more complexity. If you have specific goals, or we want to try to mitigate tax bills on death, we can do that through insurance options. And then I'm going to show you some charitable giving strategies as well that are going to apply to this situation. So first is insurance. So specifically for this situation, we have a successful couple that's built this business and has real value built up in the corporation. To meet their estate goal and to protect against tax liability, we have recommended that they move a portion of their corporate assets into an insurance policy. So we've recommended $150,000 per year over the next 10 years. So ultimately a $1.5 million investment into an insurance vehicle. It's called a whole life policy. We'll show you how that works. So why would we do that? The advantages of a whole life insurance policy for someone that has an estate goal like this is, first and foremost, it does provide an insurance coverage. Right? It's an insurance policy, so if something were to happen, there's a death benefit that's paid out, helps cover some tax liability and other maybe cost that you might have. It's tax deferred growth. So any money that's invested within your corporation is completely taxable and at the high end is passive income at a high tax rate. So what this does, it moves it into an alternative investment that is tax deferred, so no tax on the growth of this policy. We view this as an alternative investment as well. As much as it's an insurance policy, it's probably more so an alternative investment. So you think of that $150,000 per year for 10 years as an investment into another type of alternative conservative asset that grows in value. So it's a further form of diversification, essentially. There's a tax-free death benefit. So ultimately the growth is tax deferred, and upon death, if you don't surrender the policy or take the cash value, it's ultimately tax-free and paid to the corporation as the corporation is the owner. What happens here is where it gets really powerful from a tax perspective is the capital dividend account. So upon death, the death benefit will move into the corporation tax-free, and the vast majority of that death benefit ultimately creates a credit to the capital dividend account, which allows you to pull that money out of your corporation into your hands personally to spend tax-free, which is the huge challenge with a corporation is how do I get money from my corporation to my hands to spend, right? And there's careful tax planning, but this is a very powerful tool to ultimately get that money out of your corporation into the hands of, in this case, your beneficiaries to the estate tax-free, so your children, grandchildren, charities, whatever it may be. And then ultimately there's flexibility with this. So it is a life insurance policy. The clear benefit is upon death for state purposes, but it's accessible. So if there's ever a situation where you needed the cash, you want to dive into the insurance policy, you can, there's ways to do that. So this is a complicated, there's a lot going on in this slide, but I'm going to run through essentially the difference between investing your money in a conservative asset within the corporation or flooding some money into an insurance policy. So at the top here, we have money's in your corporation, you're investing it, you're earning passive income on that. So if we're comparing this to a relatively conservative investment in today's interest environment, we're looking at 5%. It's generous over the life of the investment. So we're going to assume we'll up to $150,000 per year for 10 years into a conservative investment that's paying 5% interest. Okay, so $1.5 million investment that's ultimately going to be invested until, in this case, age 89, which will be at. Okay, so again, that's taxed on an annual basis in terms of interest, and then it's taxed as a taxable dividend out of the corp to beneficiaries on your estate. So the ultimate end goal is to have a tax bill of about $1.5 million, and the estate will receive almost $2.2 million. So that's great. You've invested the money. Your beneficiaries are going to have some money through the estate, and all is good. Now, if you were to prepare for that, we have money in your corporation, and we've flood $150,000 for 10 years into this whole life insurance policy, $1.5 million investment. Ultimately, what happens is through that mechanism that I mentioned earlier, we get into details of that later if you have questions. The tax bill, because you can move money out of the CDA tax-free, the tax bill is $250,000. A very small tax bill based on the value of this. It's grown tax deferred for 30 years, and the ultimate estate will be receiving nearly $6 million. So those are real numbers. This is an exact example of those numbers for somebody in this situation. So there's a significant difference if you have money that you want to set aside for your beneficiaries and really improve your tax situation. Very powerful. So next slide. So next would be the charitable giving strategy. So they want to give some money to a charity. We can help them do that also in a tax efficient way. So there's two ways to give to charity, and many business owners may write checks here and there to support local charities or different community things. So that's great. You get the tax deduction. There's also an opportunity to donate securities in kind. So if you have corporate investments, you can actually donate those investments, and I'll show you the difference between doing these two. So on the left side, you can see here, charitable donation, you want to make up $25,000. You write a check from your corporation, you save $12,500 in tax, approximate numbers at high tax brackets. So when you get the deduction, you save $12,500 in tax. And made an impact for the community, which is great. Now, on the other side, on the right side, you see here short same value of charitable donations, so $25,000. But you happen to have some investments that you've had for 10 years, 15 years, 20 years, whatever it is within your corporation. You have a mutual fund or a stock that has a significant capital gain on it. Now we know that that's deferred until you sell it. Once you sell it, you're going to trigger a capital gains tax that you have to pay. In this case, you can say, you know what, I'm going to donate that $25,000 fund to the charity, and we have mechanisms through the Kilgour group to facilitate that. So that's all done behind the scenes. But you can say, I want to donate that security, $25,000 in value, it's the same value that goes to the charity. What happens is you avoid paying capital gains tax on that on the growth of that stock that you've had. So ultimately, that's $20,000 capital gain. 50% of that's taxable, so that's about $5,000 of tax that you saved. You also get the deduction of $12,500. So that saved you already $17,500 of corporate taxes by doing this. Plus that CDA account, the capital dividend account I mentioned earlier. So when there's a capital gain, it creates a balance in that account and allows you to pull money out of your corporation into your hands personally tax-free. So we've created about $20,000 of tax-free room for you to pull money out, which saves you another $10,000 approximately in personal tax. So again, real numbers, but a $25,000 donation done through donating a security in kind has actually saved you $27,500 in tax. So again, there's the mechanisms behind this. I can get into more detail afterwards, but that just shows the difference when you have someone monitoring your plan and providing you some recommendations based on the situation. So ultimately, to tie that back in, we have John and Mary Smith, who we've been working with. We know their retirement need, $25,000 a month, the estate goal, $8 million, a charitable donation goal of $4 million. We've modeled everything out through our financial software, and ultimately, we can come up with the magic number we talked about is they need to sell their business for $12.7 million to make this a reality, based on the assumptions that we have. Now, Steve and Bob know this number. They know what their goals are, what they can achieve at the bare minimum to meet their goals. And then also Tyler in terms of realizing that on a sale of the business. So to conclude, the end result here is basically kind of the whole package. So, inflation at 2.5%, life expectancy, lots of different assumptions we make in modeling this out, of course. Average market returns, in this case, we conservatively put it at 4.95% on average. Now we have the critical piece that we were missing was $12.7 million that they're going to have in 5 years as a cash influx from the sale of the business. That's going to produce our asset base to ultimately be 126% in terms of success rate, meaning we have more than enough cash to cash flow that $25,000 per month to life expectancy at age 90. Now, the reason we want 126%, not 100, is because our what-if analysis. So this is our sensitivity analysis to ensure our plan is robust. We have, if inflation runs 1% higher on average, we've already planned for that. So in instances like the last couple of years, it's in the back of your mind that we've already planned for this. We're still successful. We live longer, that's a legitimate risk, longevity risk. They live to 100, they still can cash flow their lifestyle. Disappointing market returns, so some underperformance some years, still 100%. Now a combination, so this is if everything goes wrong, we'll adapt, we'll make some adjustments to the plan, and they might have to spend a little bit less, but again, that's going to be monitored. Again, and then net to error, so this is the estate goal, overachieved, right? They got $9 million over the $8 million that they wanted. $4.5 million is going to charity, and the final tax bill has been reduced through insurance and some of the strategies to $2.3 million on the estate. And they have a robust plan that's given them peace of mind to move on and move into retirement with their goals defined. So I'll move. That's it for me.
Thanks, Jacob. All right, so I'm Tyler Maslakewycz. I'm a business broker. I've been working with Sunbelt Northern Ontario for the last 7 years. As business brokers, what we provide is a full spectrum service concerning the sale of the business. So our process begins with an initial valuation on the business to determine the market value. We're basically involved throughout the process, bringing in buyers, managing negotiations, structuring the deal, and ultimately closing a transaction on terms and conditions that are acceptable to the seller. So I was born and raised in Sudbury. Our office is currently in Sudbury, but geographically we cover an area as far north as Moosonee, south pretty well to Barrie, east to, I would say, Mattawa, and west to the Manitoba border. So it's northern Ontario, but it's a pretty big area in between. We're industry agnostic, meaning we don't focus on any one particular industry. Obviously, servicing northern Ontario, a lot of our engagements tend to be more industrial nature, but we sold a pretty wide range of businesses. Next slide. Bob. So when is it time to really think about retiring? The seller clients that we've worked with, we've gotten a lot of varying reasons for what led them to finally decide to retire and sell at the time that they have. It might be HR fatigue, where they're just growing tired of finding, training, and retaining reliable employees. Sometimes it's underlying health issues, increasing regulatory demands, so changes within the industry. Technological advancement is a big one too. I find that if an owner's been operating a business for the last 20, 30 years and they're involved in the day-to-day operations, and then there's a big technological change within their industry, they might not have the energy to implement that. They start thinking, well, maybe it's time to get the value of my business now and through selling it, as opposed to seeing my sales decline. But sometimes it's just wanting to enjoy the fruits of your labor. Like if you've owned and operated a business and grown it over the span of 20, 30, 40 years, there does come a time when you want to be able to turn your phone off at night and go to camp and enjoy your accomplishments. I think in any case, Steve and Bob and Jacob as well already touched upon why it's important to plan early. But with 85% of your net worth being tied up in your business, when it does come time to sell, it's a process that you want to have control of, right? It's your business, it's the sale of your business. Yes, there's going to be a buyer on the other side, but it's your business, right? And you want to have control of that process. Slide. So how do we take control of that process? So typically, in my opinion, the way that we really do take control is by broadly marketing a business while maintaining confidentiality throughout the process. And I'll get to how we do that. If you're in negotiations with only one potential buyer, that buyer really does hold a lot of control over what's, as I mentioned, the most important sale of your life. Regardless of how amicable your relationship is, sometimes it's a family member, sometimes it's an employee. In any case, if they know that there's no other option for the seller, there's no other offer on the table or no other exit strategy, they really have no motivation to increase their bid. And as the process progresses and they start seeing their legal bills and accounting bills and everything add up, they start to lose motivation in being reasonable on other terms and conditions of the sale as well. Slide, please. So at Sunbelt, we follow a process that could more or less be broken down into 5 distinct phases. So as mentioned, we begin with an initial valuation on the business. So we want to determine what the market value of the business is. And in doing so, we're looking at the qualitative and quantitative aspects of the business. And Bob and Steve had highlighted some of those. And we're looking at a number of different valuation methodologies to make sure that we're appropriately valuing that business. At the end of the day, it's a seller's decision on what they want to go to market with as far as an asking price goes. But much the same as any other market, you could spend a lot of time waste a lot of time if you're going to market at an unrealistic asking price. So we want to educate our seller clients on what we feel is the most probable selling price of their business. And we produce what's typically about a 20 to 30 page detailed document that from A to Z outlines step by step how we got to that market value so that they completely understand it. From there, we're preparing our key marketing documents. This confidential information memorandum is probably the most important. And you can kind of think of it as not quite a business plan, but a profile that details all the important aspects of the business. So it'll outline a summary on the employees, so what they're being paid, how long they've been with the company, what their roles and responsibilities are, details on customers, and we're not going to hand over or include in that a full list of your customers, but we might talk about customer concentration, industries that you're servicing, like what industries your customers operate in. We'll outline, we're going to present your financials in the best light, for tax purposes. As a private business, you're oftentimes trying to minimize your bottom line. And you might do that by expensing a personal salary, for example, through the business. So we want to recast your financials and present them in the best light so that when a buyer is looking at that information memorandum, they understand the true cash flow potential of the business. So a buyer doesn't receive that document until they've signed a non-disclosure agreement. So they're bound to the confidentiality of the sale. We also financially qualify buyers. We want to make sure that even with financing in place, they're going to be capable of completing a transaction. If it doesn't really make much sense, then it doesn't really make much sense for us to disclose that document. So how do we get that document then? How do we get the buyer's attention and get them to want to sign the NDA and want to, financially qualify themselves? And that's with a one-page blind profile. So it's kind of, you can kind of think of it as really just a teaser, I guess, on the business. So we might market a business as a machine shop located in Northern Ontario. So there are a handful of machine shops in Northern Ontario, but if that's what you're looking for, then it might make sense for you to sign the NDA and move forward with the rest of the process. In that document, we walk a fine line between providing enough information to draw a buyer's attention without giving away enough information that they could, take a few keywords, punch it into Google and figure out what business is for sale. So that's how we manage the confidentiality. When it comes to actually bringing in buyers, I think the lucky thing about what we're doing is that we have a pretty large database of buyers that we're continually adding to. So some buyers just approach us and they're generally looking for a business to acquire. We get an understanding of what their criteria is, like what their capabilities are, what their experience is, and then we can match opportunities when we do have new engagements. Where I say we're lucky is that, if we have an opportunity that a buyer might pass on for any particular reason, be it location, maybe the business is too big or too small for them, we can retain that information and then show them, another opportunity that might arise in the future. So our database of buyers is continually growing and snowballing. We also belong to a number of third-party buyer networks. And so we're able to broadly market the business to buyers that are not located in the area. So Toronto and throughout the rest of North America and even some instances internationally. So then once we have multiple buyers viewing that information package, we're screening inquiries, so answering questions about the business that might extend beyond the information in that package. And ultimately what we want to do is create a bid for the business. So going back to what I mentioned earlier about negotiating with one potential buyer, when you have multiple interested buyers at the table and they understand that the business is being broadly marketed and can assume that there's other buyers that are taking a look, it's going to get them to put their best foot forward when they make an offer. So ultimately, at the tail end of that, when we do create that bid and we have multiple offers at the table, we're going to educate our seller client on the structure of that offer, on the different components of it, and I'll get to that shortly. And really just to give them, we want to educate them on those different offers so that they can make an informed decision about which offer is the best one for them to accept. Next slide. Thanks, Bob. So as I just mentioned in structure, and this is going to tie into, I'll explain some details on that. So price is only one deal component to consider. Obviously, it's a very important one. I would argue it's probably the most important one. But there's a lot of moving parts in a business transaction. And so with that in mind, price really is only one component to consider. So structure is a big one. And I think that what a lot of owners we commonly hear, and I think that they might not understand is that there's a lot of, I would say the majority of the time really, it's not all cash that you're receiving on closing. And there's a number of ways that we could structure a deal so that you can receive that additional component. The main two I would say is with a VTB and an earnout. So a VTB or vendor take back is really seller financing. It's a portion of the deal that's financed by the seller. I would say on average, we see about 20% of the total purchase price being included in a VTB. Some owners love them because they get interest on it. If there's really good security in place, they say, well, why not? I'm going to get 5 or 6 or 7% interest every year. I'm not in a rush to collect this. There's good security. Let's move forward with it. Others just want to receive the cash on closing and they want to move to Mexico or whatever it is and not have to worry about collecting additional payments. In any case, regardless of whether you're working with a broker or not, if there is a vendor take back component on an offer, some of the things that you want to consider are the interest rate, as I just mentioned. What is the interest rate that you're receiving to finance that portion? What's the term? So are you receiving that money over a 3-year span, a 5-year span, a 10-year span? And what kind of security? So security could involve other assets pledged by the buyer. I think at the very least, there should be some kind of personal guarantee. And there's other types of security too that are often overlooked. So what we encourage and factor into the offers that we receive when there is a vendor take back component is a life and critical illness insurance policy. It sounds kind of grim, but if something, God forbid, happens to the buyer and they're not able to operate the business, if they fall ill, if they pass away, God forbid, the seller will still receive that amount if they're named as a beneficiary under that policy. So with an earnout, it's similar to a vendor take back, but what it is that it's a portion of the purchase price that's subject to the future performance of the business. Where we typically see them, and we saw a lot more of them actually throughout COVID, where there was a lot of uncertainty across a lot of markets, is, I'm going to use a round number here, but let's say that a seller feels that the business is worth $10 million and the buyer feels that business is only worth $7.5 million. Well, there's a gap there to bridge. And if the seller is very confident in that, they might say, well, let's bridge the gap by saying $7.5 million of the purchase price is going to be received on closing in cash. And that remaining $2.5 million is going to be paid, there's going to be subject to the business achieving a certain revenue goal or a certain profit goal. When there is an earnout in place, again, whether you're working with a broker or not, some of the things you want to consider is how attainable is it? So again, using a $10 million in revenue figure, let's just say that a business over the last 5 years has historically achieved around 10 million in sales per year. If that additional sum is triggered subject to the business generating 15 million in revenue, as a seller, I might look at that and say, well, how attainable is that? I've owned this business for 20, 30 years. Even if the buyer is highly capable, what are the odds that they're going to be able to generate an additional, 5 million in revenue per year, and then I'm going to receive that. Further to that, if there is, let's say, a realistic metric in place as far as determining how it's earned, from a seller's perspective, you typically want that to be tied to revenue or sales because there's less ambiguity in revenue or sales. Again, if your business consistently generates 10 million per year and that earnout component is triggered at, subject to the business achieving 10 million in sales, you're like, well, it's revenue, it's predictable. I know what my industry, what my customers are buying, and I think that's attainable, and I move forward with it. If it's tied to profits, I'd say there's a little more of a gray area. From a buyer's perspective, understandably, you want to tie to profit. That's revenue is important, sure. At the end of the day, profit is really, what you operate a business for. So when it's tied to profits, a buyer could, in theory, increase expenses after acquiring the business, and some of those might be legitimate business expenses, but some of them might be personal expenses that are, being hitting the income statement of the business. And at that 2-year mark or 3-year mark or whatever that earnout is supposed to be triggered, they might say, sorry to the seller, I didn't attain the profit goal that I thought I would, and I can't pay you. So again, whether you're working with a broker or not, you want to consider the metrics and how attainable that is. Working capital is another large component of the deal. I'd say next to the purchase price, it's probably the component that we negotiate on the most. It's an accounting concept, and I won't go down the rabbit hole of explaining the element of it, but because it is unique to each business as well. But in any case, it's an important consideration and one that should be addressed at the offer stage. So give you a quick example. I was working on a transaction a few months ago, and the seller had narrowed down the offers to two particular offers. So The one offer was 1.7 million, which was at the asking price, and it seemed pretty good. It was owner operator, someone in the community. They had good experience, and seemed like a really good fit. The other offer was a financial buyer. It was a private equity group, and that offer was 1.8 million, which was a premium on the purchase or on the asking price. And at face value, you're looking at it thinking, well, it's a no-brainer. There's an extra 100,000 contributed to the deal. As we read through that offer, it was outlined that working capital would be subject to their review and due diligence. So now you're going, well, there's some gray area there because cash is one component that could be included in working capital. Whenever you see working capital outlined in an offer, you want to know what the target amount is. So you want that addressed up front before you accept the offer and go down the process of due diligence and securing financing, because if there's, let's just say, a 2-month lead time till closing, and you accept that offer, and now as a seller, you're going through planning for the eventual sale, and then you find out in the 11th hour that they're expecting 500,000 in cash to be left in the business. Well, that totally changes the offer. That $1.8 million offer is now, in the seller's eyes, 1.3, right? Because you're looking at what you're going to be left over with after you sell. So working capital is a huge component, and one that I'd be happy to explore in other private conversations, but for this purpose, it's a rabbit hole we won't go down. So other terms and conditions, I just kind of touched upon one, but it's a due diligence process, but the lead time to closing. Oftentimes, when a buyer submits an offer and it's accepted by the seller, they want to they want to be working exclusively with that seller, and rightfully so. They don't want to incur legal fees, getting a share purchase agreement drafted, accounting fees, having their accountant review the financials, and so on and so forth, only to find out a few weeks later that the seller is going to be selling the business to someone else. With that in mind, if they have, let's say, like a 6-month lead time until closing, meaning they want to, once the offer is accepted, they're planning to close 6 months after the fact. There's a lot that can happen in 6 months, and that's a lot of time as a seller to be dealing exclusively with one buyer. So if, God forbid, in the 5th month of that process, the buyer decides, it's not a good fit for me for whatever reason, and I'm walking away, that's 5 months you've lost on the market. Culture, legacy, and employees, I'd say they all kind of fit together. But as Bob and Steve had mentioned, for a lot of owners, like you want to see, especially when it's that business is your baby, you put blood, sweat, and tears into building the business, made a lot of sacrifices, developed a lot of good relationships with your employees. You want to see it flourish. And, as much as there are some attractive offers potentially at the table, you want to look at the qualitative side of that buyer. Like, how good of a fit are they? Are they going to treat my employees the same? Are they going to completely change the business? If there's a vendor take-back component or earnout involved as well, you're going to want to focus a lot more on that buyer, because if you're not receiving all your cash on closing, there's a risk element to that, right? If the buyer doesn't do well with the business, it could impact the proceeds that you're going to receive down the line. So again, with one potential buyer at the table, these are some of the other elements that you lose control of. So how long does it typically take to sell? So this is kind of a loaded question operating in Northern Ontario. It's a very diverse business landscape, and I would say, as you can see here, 7 to 9 months is our average time frame. On the other end of the spectrum, it could take, we've seen upwards of 2 years. The examples that I'll give in those circumstances is we've sold a few businesses in Moosonee. If you're familiar with Moosonee, or if you're not, there's no road access. So that's a difficult conversation. Again, if you're keeping the sale confidential with that teaser document, and you're marketing, we market it as a business in whatever respective industry located in a rural Northern Ontario community, it is that, but it's very rural and there's no road access, and that's a deterrent for buyers. So it could take a little longer for some remote areas in the north to find the right buyer. And then just to add to that as well, and I probably could have touched upon that in the last stage, but another important component is the training and transition period. So this doesn't include that period. I think it's important to budget time as a seller, because you want to also be cognizant of the fact that buyer is likely going to want to retain you for a certain period of time. It's going to be case by case, depending on the buyer's comfort level, depending on how niche the business is, and how much of a learning curve there is to get behind. But that could be anywhere from 3 months. It could be, I've seen 2 weeks, and it's a matter of like, tell me where the light switches are, and then that's it. And then on the other end of the spectrum, I've seen upwards of 2 to 3 years. If that's the case, you're going to want to know what your compensation is. You're going to want to know what your expectations are. So I've actually seen the training and transition period be really beneficial to the seller as well, especially when the business is such a big part of their lives. Because if they really enjoy certain aspects of the business, but again, going back to some of the reasons for retiring, they are getting tired of the administrative duties, hiring, retaining employees. If they can scale back and almost get back to the core elements of the business that made them want to get into that business in the first place, whether it be a particular trade or whatever it is, they're oftentimes happy to be retained by the buyer for a longer period of time. And maybe they're reducing their workload from 40 hours a week to 20. And again, it's doing the tasks that they enjoy doing. So important steps to consider. If you could, perfect, thank you. So planning early. Bob, Steve, and Jacob have already covered this, I'd say, fairly well. So did the job for me, but obviously it's very important to plan early. Again, I think that, when it's probably the most important sale of your life as a business owner, it's one that you want to get right. And I would say it's probably most relevant when you get to the sales stage, even if you have built value in your business through a consultant and you've worked and you've got a great financial planner who's got a great financial plan in place. If it's an underlying health issue and you've kind of overlooked that because you've been busy operating the business, when it does come time to sell, you do lose a bit of control, because if you have a 3 to 6 month window, let's just say, you might not be able to hold out for the better offers. So plan early, budget an appropriate allotment of time. Control the process. I've talked about ways to do that, but again, it's the most important sale of your life. It's your business. You built it. You want to make sure that you're in the driver's seat. Maintain confidentiality. So I've touched upon how you maintain confidentiality, but why is it important? So I would say there's a big misconception with employees where employees, once they learn that the business is for sale, it can spook them a bit, especially an employee that's been there and, grown close to the owner, who's been with the company for 20, 30 years. If they learn that the business is on the market, there's going to be a new potential buyer, they might get spooked thinking that they're going to, get a reduction in pay, that the buyer is going to be overly demanding of them, and so on and so forth. I would say it's a misconception, because with the vast 99% of the time, with a buyer coming in, there's a lot of value in those employees for them, especially in the earlier months and years when they're learning the business themselves and who's doing what. It's actually, oftentimes the opposite, in that things really improve for that employee. So they might implement new benefits for employees just to retain them that they didn't have before. But in any case, if your employees find out that the business is for sale and they start looking for work at a competitor, for example, that can really impact the value of your business. So especially if you're in the middle of a sale process and God forbid that falls apart, well, now you're going back to the market with less employees. I would imagine a lower value on the business. And even if you know that you can find some employees fairly quickly, depending on their roles, it's a difficult conversation when you're talking to a buyer and sales are trending in the wrong direction. And furthermore, if sales are trending in the wrong direction and you do have a buyer, it's a difficult conversation when you're trying to get financing. So remove yourself from the business if possible. If possible, being you might have certain roles that are yours as the owner and they're going to be inherited by another buyer coming in. But if there's administrative duties that can be delegated to a new employee, or by hiring an employee, look to do that in advance, because it just makes the business more saleable. It could drive up the value too, and command a premium on the business. A business that requires 10 to 15 hours a week from the owner has a lot more value than a business that has an owner working 60 hours a week. From a buyer's perspective, especially when you're dealing with strategic buyers that are companies that are existing companies and not so much an owner operator, if they're going to be delegating employees to fill those roles and the owner of that company is not going to be operating the business themselves, they want to make sure that they don't need to hire 2 or 3 employees to try and assume that position. So remove yourself where possible. Focus on maintaining and growing your business throughout the process. So just kind of touched upon that because I feel like it goes hand in hand with confidentiality. But again, if you're bogged down with working with a buyer and trying to sell the business, and it's demanding a lot of your time, and as a result, sales start to slip. If again that deal doesn't go through with that particular buyer, you don't want to find yourself in a position where the business is actually at a lower value than it was before you started the process. In my opinion, I think that's what a broker brings to the table. It's a large part of our value is that we're going to manage the entire process from A to Z. So, and I think that having control in that process and a process to follow ensures that the owner can stick to running the day-to-day operations and not have to worry about a sale falling through. Minimize, defer, or eliminate capital gains tax. So that's Jacob had touched upon some good ways to do that. And yeah, again, you only get one chance to sell your business, so you want to get it right.
Right. Okay.
So yeah, in summary, our job as a broker is to confidentially sell your business for the maximum amount in the shortest possible time frame with the least amount of risk.
Perfect.
Thank you.
Okay, I'm just going to summarize with one slide. Thank you, everybody, for that presentation. Really, a summary here, and it's only one slide that we need, is you need an aligned team of advisors. And I think you've seen that between the 3 groups represented here today, there's some really specific capabilities and strategies that are all designed to assist you as a business owner, as someone who's going to the next transition in their life, to maximize the value that they bring with them. Now, others who may or would be involved in this, your accountant, your lawyer, but we also see a lot of clients who feel that, oh, I'll just do it with my accountant and lawyer. They're critical parts, but they don't have all of the network, all of the, the expertise and all of the processes that can help you absolutely maximize. You need a roadmap, okay? There's a saying that if you don't know where you're going, any road will take you. In this case, if you take every road, you probably won't know where you're going to end up. So it's really critical to have the roadmap, and that roadmap takes time. All right. One of the things hopefully you glean from this, these presentations is that this is not a 2-week, 6-month, 2-week, 2-month, 6-month process. If you want to maximize the value that you're able to pull from your business, and if you want to maximize the value by having some great tax strategies, you've got to put these things in place now, and these can take 2, 3, 4 years if you absolutely want to do it right, and to maximize your value. And absolutely critical here is knowing your number, knowing your next step, where are you transitioning to, and by knowing all that, by pulling together the right team, by giving yourself the time, there's no doubt that you'll be able to achieve your goals. So we wanted to open it now to people in the room, people online. If there's any questions, please, we're here as a team, as a group. Please be free to ask.
Lead us off with a question.
Yeah.
I hope it's not loaded of a question. I think, Jacob, you might have touched on this a little bit, but how could trusts be used to maybe speed up the process and maybe eliminate the probate and all that kind of stuff?
Yeah, so in terms of the trust, to be honest with you, that would probably have to be a more detailed discussion. With IG, Private Wealth Management, the group that we have, we actually utilize, so through IG, we utilize specialists in a number of different areas. So our group, investments, the financial planning, tax planning sort of thing, getting into details about trusts, we'd probably bring in more legal people on our team to give you information about that. So I know I'm not answering the question directly right now, but as part of our process, we have insurance specialists, tax, like a team of legal and accounting people with us that we would bring in for more complex situations. Trust would be one of those situations.
Right, okay.
Any other questions?
Just with regards to vendor take back, in your opinion, when companies have done vendor take backs, has some of those terms been with relations to, payments? If you're falling behind on payments, then basically the company becomes back,
Yeah, so that's another form of security too. There are and that's what I was mentioning, one of the components. So that's you might be talking about a share pledge where the shares are transferred back to the seller. I don't particularly love them myself because I just think that if you're in a position as a buyer where you're defaulting on your loans, what does that say about the business, the state of the business, right? Like you're inheriting, and now as a seller, you're getting back into, you're inheriting the business that you sold, and it's now in a mess that you might not have left it in when you sold, right? So I don't particularly love them. Yeah, like we do see them on some transactions. Some sellers, they want to have that in place, and it's their decision. I just think that there are better forms of securities.
like the personal guarantee and.
Yeah, and sometimes, like, quite frankly, depending on the buyer's position, depending on the financing mix, it might go as far as being a second mortgage on their personal property. And again, that's probably less than ideal too. From the buyer's perspective, that's a huge risk, but some people have, different appetites for risk, and they're willing to have that pledge, to purchase a business.
Great. Any more questions? If not, and if there's any questions online, please let us know. Just unmute and ask us the questions. We'd be happy to answer them.
I just have one quick question. With lots of people around my age, 20s, 30s-ish, that are buying out businesses now, how early, I think you had mentioned, Tyler, start early, how early is that? I know some people are beginning succession transitions. Should they already be thinking, I'm 30, I'm buying out this business, what's my retirement plan? In your opinions?
So,
Yeah,
I was gonna say, that's probably your.
Yeah, I mean, I think from a succession standpoint, it's never too early. Obviously, as you get closer, it gets a little more powerful. Some of the variables at play will be, be more clearly defined and that type of thing. I mean, from a financial planning perspective, the earlier you start in all regards, the better, right? Investments, compound growth, having a plan in place, insurance, right? The sooner you start the insurance process, the more favorable your premiums are. So getting started in that process and having us put together a plan like the one I showed you, it may change. It likely will change, I should say. But creating that relationship and start planning early is going to allow us to adapt and put a plan together and just keep you on track and get you ahead. So.
This isn't really, I guess it doesn't really answer your question. Well, Jacob just did, but what's actually been pretty unique is that you have quite a bit of buyers that are relatively young. Mm-hmm. And I think that going back to reasons for selling, one of them being technology and changes in technology, there's been a lot of changes in the last 10, 15 years. And just to give you an example, had two buyers that have actually purchased a few businesses from us now and done very, very well with them. Two that we like working with have been very fair to the sellers as well. They realize the value, they're long-term oriented, and they're happy to pay what the business is worth. But just to give you an example, so one of the companies that they acquired didn't have a web page. And so, just virtually, not only didn't have a web page, had virtually no online presence. So just, some simple things like that, implementing a web page, focusing a bit on online marketing, they were relatively easy tools, I would say, to really grow revenue for them. So it's a pretty unique time right now. And we're sold businesses to a lot of relatively young people.
Jasmine, I think one of the drive, certainly personal financial planning, but if you think about business tax, there are certain things that you can put in place from a tax perspective using an accountant or a tax lawyer, which really do need, I would say, a minimum of 2 years to be in place in order that you don't get in trouble with the Canada Revenue Agency.
Right.
So I would say, unless you've got your act together from the planning point of view with corporate tax, you really should be looking at a minimum 2-year timeframe. And then the other important thing to think about is if you figured out what your value gap is, what your wealth gap is that you need to fill, the bigger that number, then typically the function of time elapsed in that equation is going to loom, fairly large. Obviously, the bigger the gap, the longer the time. And so, you're going to hear a lot of people say 3 to 5 years. That's a long time. But I think really you're kind of, you're in the time frame of 2 to 3 years practically. And within those 2 to 3 years, there's a lot of stuff to do, So, I mean, I like to give you a decent answer, you don't really want to be less than 2 years. And the quid pro quo to that is if you are less than 2 years, that's not a problem. But here's the ramification. You are leaving money on the table.
Right.
By not having that length of time because you haven't got the tax planning in place, which means you're going to pay more money to the government out of your purchase and sale price. So that's kind of the deal, really.
Yeah. Well, thank you. That's super helpful. Definitely share that with my business network that's just getting started, but it's important for sure.
And I would say one other thing that from our perspective, the way our industry operates is what we see a lot is, I talk about comprehensive financial planning, it's sort of a cliche term, right? There's a lot of things that we advise on. There's to have a conversation and go through that discovery process may open someone's eyes to the possibilities, and it's a non-committal conversation, no fee structure for that. And oftentimes what we see is we have people that, already have some investments that they're paying a fee on already, but not getting the comprehensive service. So essentially by making sure you're working with the right person, you could be paying the same fees you're already paying that are typically tied in our industry to investments, but not getting everything that you want. So our value proposition is really around value for fee. And oftentimes people are already paying that fee and that might deter them from talking to somebody.
Right.
And it's just a matter of working with someone that's going to provide you the value where you feel, comfortable with the value for fee essentially, right?
Yeah, and if I could just add to that, often, the natural question for, people around the table and many business owners is, well, what does all this cost me? This sounds like a lot of effort and a lot of money. Here's what I would say. There is a lot of, with experienced advisors around the table, there really is a value proposition to bringing that experience, to bear. And what we definitely see is that there is a return on investment of many times. It would not be unusual for a return on investment to be certainly greater than 5x. I would say 10x. And frankly, I could show you multiples more than that as well. So, the fact of the matter is there's a cash flow impact, of course, but the return on investment for good advice can be quite substantive and very persuasive if you really need that good quality advice and people around the table.
And just think of the benefit of having, a couple of years to prepare your business for that sale so that you're maximizing value. That's one of the returns. Having a number of years to work with, someone like the Kilgour group, so you can make sure that you've got tax planning in place and that you're doing it, legitimately, and that, you're going to minimize your tax burden at that time. And then finally working with Sunbelt or someone like them who can bring multiple buyers to the table so that you're in a situation where you can command the best price and also shepherding you through the whole process to make sure that the deal that you get is the deal that you want. All of those are that return on, the investment that Steve is talking about. So it really does make sense.
What word of advice can you guys give to, even, to Jasmine's point here, where there's a lot of young entrepreneurs kind of entering the market and taking on these, 500,000 companies that are going to be selling by the end of 2025 in terms of, just young people with probably not a whole lot of money or a whole lot of assets to be able to secure that, to take on, to buy one of these businesses. What are people doing?
I'll kind of put something out there, but I mean, there's a lot of partnerships that you can create as a young person, and it doesn't have to be a young person in their 20s or 30s. Middle-aged people in their 40s and 50s who are looking to acquire a business. You can go and partner with private equity. There's a bunch of different things that you can do. You can negotiate deals where there are vendor take-backs. As long as you are working from, a position of integrity, you'll find that the sellers are very often willing to work with you because it helps them achieve their goals as well. And these days, when you think about it, there's a lot of money out there, in the market, looking to be placed with, successful, energetic, intelligent, smart, entrepreneurs who are going to take that business to the next level. So it's actually a great time, if you are in a position to buy a company, young, middle-aged, or otherwise, it's a great time to be out there because there's a lot of companies coming on the market because of people transitioning.
And with those young people, primarily go and look for money at a bank or at, those types of.
So, just to speak to that, I think that that's, and probably answer your first question as well. I think it's finding the right people to talk to. I hear of people that, I hear just circumstances where a buyer was looking to acquire a business, has a business in place, and walks into their, let's just say, a bank with RBC. They walk into their local branch and approach a teller, and they end up, sorry, I shouldn't say RBC, I didn't mention a particular bank. They end up talking to the wrong people, right? And I think that sometimes the wrong people might just be based on the lender's criteria. So different lenders have different criteria. Some banks will lend on cash flow, others won't, right? And so it's talking to the right bank, because I do hear circumstances where someone approaches one bank, that bank, for any particular reason, doesn't have an appetite for that type of business, passes on it, and they think, well, I'm not going to get financing. It's like, knock on some doors, so.
Yeah.
There are many sources of finance out there in the market, and the different sources of finance have different risk appetites. Mm-hmm. So when you talk about a high street bank, frankly, a high street bank is really not there to help you invest in equity in a company. They are there to service particular needs, typically working capital needs and so on. And they take security on the assets of the company. So, if you're looking to acquire a company, you're taking on equity type risk, and a bank is probably not the best place to go. However, they may give you a portion of your finance for a particular reason. So, I think the young people who are looking to do that need to do their research. There's places to go for advice. For example, Mike and Roxanne, do this, do that every day of the week, and they help young people to kind of put them in the right place in terms of doing their research. I think the final point I would make is for young people in particular, what they've got in their favor is they're much closer to the leading edges of technology than people that own businesses and are near retirement. So they can leverage those new assets in the business. And I think they particularly need to put a plan together, because they will need to pitch the various capital providers and showcase to them that what they're proposing is a workable plan that is financeable. So there's a bit of work to be done, but it's having done the right due diligence and put a plan together with the help of some of the incubator type advice out there, they certainly can find the right sources of finance. Not necessarily just the bank though.
Yeah, definitely. And I think that's kind of, a young person going into it and saying, hey, like, I'm just going to go to the bank, and the bank will shut you down, right?
And they say, oh, I'm not going to buy this business now.
Yeah, exactly. Like, oh, there's no way I could get, $1 million to buy your business or $2 million to buy your business. And so I guess that's kind of hey, utilize the resources and take advantage of that to find, the best avenue to make it happen.
I would actually personally argue the opposite. I think that a lot of people underestimate themselves as far as what they'd be able to get for financing. Banks are probably, tier one lending institutions are probably involved in 95% of our transactions. And I think that, with a mix sometimes involving a VTB, banks like to see VTBs. It shows that the seller's got some skin in the game too, that they have confidence in their business. And so my point being, and sometimes banks will view VTB as an equity component for the transaction. So point being is that I don't think that, if you're acquiring $1 million business, that you have to, have 500,000 in cash in your back pocket either. So
No, maybe like a $5 million business.
yeah,
right?
well, that's
Or if it's somebody that doesn't typically have a business, it's just one of the employees or whatever, right? That gets.
yeah, absolutely, and that's the difference there too. I think something that I probably could have touched upon is that there are different types of buyers depending on the size of the business. Like the average owner or operator who's going to be purchasing the business themselves, and running the business themselves, they might not have $1 million in cash if it's a $5 million purchase, right? So that's a different scenario. But if it is a business where depending on the size of it, that it's attainable for an owner operator, if they have good experience and there is there's some creativity in the structure, again, vendor take back being one of them. Again, I think that people shouldn't underestimate themselves and see what's available.
Well, I think that's amazing. Thank you so much for sharing that. And I think that's really good conversation. We are over time, but I think it was very valuable to be over time in this case. So just on behalf of the Timmins Chamber of Commerce, I want to thank all of you for being here today. And thank you everyone for tuning in online as well. I think this information has truly been invaluable, and I'm excited to share this with our networks. And thank you to Venture Center and the Business Enterprise Center for also sponsoring this financial pillar. It's very important for our networks. And anything else you'd like to close off with?
Well, Jasmine, just one request.
Yes.
Everybody around the table would always value feedback from your members. So if we could ask them electronically to give us some feedback on, whether this was useful, which bits of it they really liked, and so on, that would be very valuable for us.
Sounds great. I'll definitely do that.
And on behalf of all of us, we'd really like to thank you for hosting us, and thank you so much for being sponsors, and great meeting.
Thank
you.
All right.
Yeah, thank you.
Okay.
Thank you. Sign off here.